been quite a week on a lot of fronts. It's a good rally in the stock market, one of the best since 1933, and quite a week for stimulus and other records, which we'll talk about in a minute. We wanted to start today talking about some of the known unknowns and provide an update on a couple of areas. First, on the update on the COVID-19 caseload. Unfortunately, this week we became the leader in cases in the world, and that's not a thing you want to be known for. But as you can see in the graph, every state showing signs of cases and infections. There's concern that the case spread is going to increase in states over the next few weeks, and we expect that to continue. On the vaccine front, there's been a lot of good news, but unfortunately that doesn't help our acute case load, as the vaccine probably won't be around for another 12 months or so. On the economic side, the narrative right now is about depth and duration. And Mike, why don't you give us your thoughts on that?
Yeah, currently the consensus is that this will be an extremely deep drop-off in GDP. The consensus is this will be an employment crisis and a health crisis, and we're seeing plenty of signs of both of those things. The health crisis in the growth rate of cases in the US, and then the employment crisis showing last week weekly jobless claims over 3.3 million, which is a new all-time record. So the consensus is a very deep slowdown in economic activity with a lot of jobs lost. But the hope is that it will be relatively brief, and that stimulus will provide the bridge to allow businesses to maintain their payroll, and folks that have lost their jobs to be able to pay their bills during this hopefully brief recession.
Let's talk about the fiscal and monetary stimulus and sort of size them for people, because it is unprecedented and on both fronts, and give us some context of both of those and how they relate historically.
Mm-hmm. So the fiscal stimulus package, which is on Donald Trump's desk to be signed, is $2 trillion. Which is much larger than the fiscal stimulus package we had in 2008 during the global financial crisis, which was right around $800 billion. So there's a lot of good stuff in there that should help people out, direct payments to families, but a lot of money in there for small business loans, small and medium-sized enterprises, loans that will serve as bridge loans, and if you maintain certain levels of employment, will basically turn into grants. So basically free money. So on the stimulus package, a very large stimulus. And, the expectation is that this might not be the last we see out of fiscal stimulus. This is phase 3. And there have already been talks about if a phase 4 or a phase 5 are required, if this protracted period of economic activity lasts longer than expected, that Congress would be willing to do that. So just very, very supportive of markets on the fiscal side.
Yeah, we've had numerous comments from senators saying that this is sort of the first of this, and the longer this goes on, the more willing they will be to do more.
Yeah, and when you take the fiscal stimulus and you add what the Fed is doing, and the overall size of the monetary stimulus we're expecting, we're expecting somewhere between 5 to 7 trillion on the monetary stimulus side. The Fed is basically doing as much as the market needs, so it's difficult to say with a lot of certainty exactly how much stimulus will be done. But if you combine quantitative easing, all the new special purpose vehicles that have been announced this week, and then additionally the funds in the fiscal stimulus package, $377 billion to support small business loans, the Fed can lever those up 10 times. So you combine all this fiscal and monetary stimulus, you're looking at potentially $9 trillion in stimulus, which is about 40% of GDP.
Right.
All the stimulus that the economy received, fiscal and monetary, in 2008, that was somewhere around 20% of GDP at that time. So just huge in terms of magnitude, and then also the speed. There's no doubt that the stimulus in 2008 was ultimately too little, too late.
Yeah, and one could argue that that's also supporting what we've seen in the market this week. As this information came out, that turned a lot of people to say, well, it's safe to buy stocks again.
Exactly right. We were talking about, is this a bottom? What do we need to form a bottom? That's the first step in the recovery process. It's just form a bottom. We hadn't
Mhm.
even seen 2 straight positive days for U.S. equities until this week. And if the expectation for 9 trillion in stimulus is not enough to just form a market bottom, then that's the point where you have much bigger things you need to worry about.
Our research team did some really interesting work comparing what's happening now to 1987. So we have a graphic we'll pull up. Why don't you walk us through the comparisons and similarities there?
We had spoke previously about V-shaped recoveries and U-shaped recoveries, and the strength of the 3-day rally this week, definitely brings a V-shaped recovery type scenario in markets. It brings up the probability of that. So we wanted to take a look at, what's a classic or most severe historical case of a V-shaped recovery, and that was Black Monday, 1987. So what we've done here, the green line, we look at all the price action from 1987 heading into Black Monday, and then the full recovery period, which took almost 2 years afterwards. And we've overlaid on the exact same time period what the S&P 500 has done during this downturn. And you can see the lines basically lay right on top of each other. So from their peak, whether you're talking about 1987 or here with COVID-19, you're down 37% from the peak in about 1 month time. So a very severe, sharp, quick drawdown. Then the sort of classic behavior, even if this is a V-shaped recovery, what you typically see is when you start to form a bottom, it's evidenced by you retrace about 20% of your losses from the bottom. And that's basically what we had this week. And while you're doing that, you're getting very high trading volume. So the market is saying, I believe this could be the bottom. They're sort of voting with dollars and with their feet. That's the first stage in what's called the bottoming process. So it's been very interesting. A lot of clients have been reaching out. Oh, is it too late? Should I get in? Should I get in? Am I going to miss it? Even if this is a V-shaped recovery, the bottoming process takes time. And you
Right.
see that in 1987 as well. For about a month, there was a tremendous amount of volatility, and the market came back down and double bottomed, meaning it came back down to those original lows. If we follow that behavior over the next 4 to 8 weeks, then you would think we would come back down to the lows from this past Monday. And that would be something that would be very typical for these types of drawdowns. So there will be a lot of volatility still. It's quite possible that we retest the lows from Monday, but we hope this is enough that, hopefully the bottom is in. And going forward, stocks are still the only game in town. That 2-year recovery period in 1987 was a great environment to own equities.
Right. And that's an important point. Stocks are the only game in town because unfortunately, or fortunately, depending on where your seat is, something else interesting happened this week, which is for the first time ever, we had negative interest rates in the United States.
That's exactly right. The 3-month Treasury bill yield, so not directly controlled by the Fed. The Fed controls the federal funds rate, but the 3-month Treasury bill usually trades close to that. It dropped down to negative 14 basis points, negative 0.14% yield on Thursday. So, there's been a lot of concern. How is the government going to finance this large fiscal stimulus package? Well, that certainly helps. The U.S. government on Thursday could issue 3-month Treasury bills at a yield of negative 0.14%. They're literally getting paid to issue debt. The expectation is that likely won't persist because once the increased supply of Treasury bills comes on the market, once the government and the Treasuries start issuing new debt, hopefully these should normalize somewhere around zero. But it just goes to show the magnitude of what the Fed is doing, the sheer magnitude to bring the 3-month Treasury bill into negative territory this week.
Great. Well, let's take a quick look at the impact of all this stimulus from the Fed side on the actual Fed's balance sheet and show us relative to what happened in 2008. I think there's size and speed are two interesting characteristics of a difference today.
Yeah, exactly right. If we start out and look at how the Fed increased their balance sheet in 2008. A couple things to look at on this chart. So if you focus on the left, you can see the red shaded area that marked the economic recession in 2008. You can see the Fed didn't start increasing their balance sheet until it turned out we were already quite far along in that recession. And then ultimately they increased the size of their balance sheet by about $1.2 trillion, which back then was a huge amount of money. But compared to what's going on now, it's kind of chump change compared to what the Fed is doing right now. So if we go all the way out to the right, you can see in about 3 weeks' time, the Fed has already done about $1 trillion in stimulus. And these numbers don't fully incorporate what's going on this week, where they picked up the pace. So in our view, at the current pace of expansion, the Fed should be somewhere around 8 trillion in assets on their balance sheet by the end of May. And the size and the magnitude of that is going a long way already to help stabilize credit spreads and lower borrowing costs for corporations. We've started to see signs that the U.S. Treasury market is behaving a lot more rationally and functioning more normally. And all those things lead us to believe that, those are coinciding potentially with the S&P 500 forming a bottom.
The Fed balance sheet has expanded, is expanding, and it's already, before it's even started, having an impact on fixed income markets. They were in pretty significant dislocation the last 2 weeks. But as evidenced by this next chart, just the talk of buying assets has already sort of calmed the market.
Yeah, on Monday, the Fed announced new corporate credit facilities. So this is their first venture into buying corporate bonds. And just that announcement, basically the provisions within that corporate credit facility announcement say that the Fed can buy up to 20% of the outstanding shares of ETFs, exchange traded funds that invest broadly in U.S. investment grade bonds. So the poster child for that provision is the LQD, the iShares U.S. investment grade corporate bond ETF, one of the largest corporate bond ETFs out there. So this week had a net inflow of over $5 billion. So a record weekly inflow. And these inflows were happening, before the Fed has even set up the credit facility. They're just the ink had not even dried on the announcement, and the facility was not yet up and running. So you can see just by the Fed signaling they're willing to do this and signaling they're willing to do it in almost an unlimited capacity, what it does is it allows the market to do their work for them. And all these inflows went a long way in stabilizing credit spreads. We for the first time during this drawdown have seen new corporate bond issuance. So signs that what the Fed is doing, this unprecedented monetary stimulus, really doing a lot to calm markets.
So we get questions from time to time. One in particular is, why would you front run this? Like, what's the value of front running this?
So the value is you can make outsized returns before you basically get crowded out of your trade. So before the Fed made this announcement, or right after they made this announcement, yields on investment grade corporate bonds were very high. And the expectation is the Fed is going to lower those yields. That's if the Fed is going to look and say, hey, our monetary stimulus, was it effective? That will be the metric. And
right.
So if you get in while yields are high and you get crowded out of your trade by the Fed and get out while they're low, you make some money.
So it's almost like, in simplistic terms, if I know that someone's coming with a big wallet to buy a bunch of lemonade, I want to open a lemonade stand.
Exactly right.
So thanks for joining. We've got a lot of video content planned for next week. We'll be doing our monthly review on Wednesday, so look for that. And we're also going to be providing updates on the fiscal stimulus and what it means to you individually. There's a lot of questions about who will get it, how will I get it, will I get taxed on it, will I have to pay it back? And those are things we want to help our viewers understand. So look for more from us in the very near future.